Well, what's going on, everyone? Welcome back for another episode here of Let It Grow Investing. I'm Jeff, and we're back here for another one. We're going to talk everything stocks, everything investing, and we're going to try to get caught up on Q2 earnings. What's going on with the Fed? What's going on with some of these Mag 7 names? What's going on with the rest of the market? Is it just the Mag 7 or the semiconductors that are driving this market? Or are we actually seeing other stocks start to rally? And that's what I'm all about right here. We took last week off. I was down in Costa Rica with the family. Great time. Love the area. Probably one of my more memorable trips that I've been on in recent memory. So it was a good one. I had a great time down there. So good to get away, right back into everything right when we came back. Busy couple days getting back into the swing of things. And now we are here. It's Sunday. It's kind of later in the day. We were celebrating my parents' 51st wedding anniversary. So happy anniversary to them. And let's roll right into it. Let's get into some things. So what happened while I was out? Well, we had a lot of earnings that we were trying to get caught up on, right? We had a bit of a rally here this past week, right? The S&P 500 was up 3.6%. The NASDAQ was up 5 points. The Dow was up 3%. So it's not just simply 4 or 5 names that are driving this market. Typically, we think Mag 7, maybe minus Apple, minus Tesla. Take those out, and that's been driving the market, right? We also had AMD, Micron, some of those other names that are big drivers of growth right now. Anything semiconductor, AI related is really what has been driving the market. But now we're starting to maybe grab another gear, find some other medical stocks that are working, maybe find some other industrial stocks that are working. And we're starting to see that market widen out, which is a really good sign. It's a really positive thing overall. I don't like when only a few stocks are really driving, that stock market to go higher. We actually saw NVIDIA start to get back in on some of the rally. We saw Amazon go. We saw Celsius not do so well. We want to talk about that also. A lot of different things that we're going to take a look at, right? So, but overall, earnings are much better than feared. So that is a big concern, right? Everyone's spending crazy amounts of money. We talked about CapEx. We've talked about how that keeps pulling some of these companies back when they're saying, hey, yeah, we're going to build out more AI. We're going to buy more chips. We're going to build out a new platform. We're going to build out a new data center, but it's not making the earnings look great. And so that has been a big problem. But right now, about 90% of S&P 500 companies have reported, and roughly 86% of them have beat expectations. So that's, pretty substantial that 86% of the companies that are out there had said, hey, we're going to be here, but we came in here. That is a great thing to see. So that is a huge thing that is driving the market, right? That's why we're getting those gains. AI spending continues to translate into earnings, right? We saw Microsoft, Amazon, NVIDIA, strong results. The massive AI infrastructure spending is beginning to generate meaningful economic returns. So the stocks that we follow, NVIDIA, AMD, Broadcom, Microsoft, Amazon, that has been doing really well. The jobs data, we did get some jobs data that was an unexpected decline in payrolls. And normally we think that's a bad thing, right? But what does that do? That puts a little bit of pressure on the Fed, right? We see the Fed maybe say, hey, we got to do something. The economy's good, but the weaker labor market, we've also got cooling inflation. Also, because oil prices kind of came down, maybe we start to see some Fed help, right? The economy's strong enough, but we don't have enough jobs, right? So we want to get these people working. If we lower rates, maybe people can afford a little bit more. Maybe these businesses can afford to hire a little bit more. So we've got that, right? So, but yeah, the breadth of the market is improving. So that is a huge thing. Although the S&P 500 is not cheap. We are trading above the forward PE. So that is something that we want to be mindful of. Where are we investing? How much are we allocating to a specific position? Basically, how much dollars do you want to put into play in any one spot? For me, I try to take a look at that. How risk on do I want to be in something like a Celsius or a SoFi versus maybe something like an NVIDIA, or that might not be your best example because that is kind of boom and bust. It feels like maybe more and more less anymore. We're looking at AMD kind of being this rocket ship company. It feels like that's got to cool off at some point, but they are announcing the MI 450 chips, and I think we're still in the early innings for them. I still think we're in the early innings of AI. So there's a lot of different things right there, right? As far as your actual stock market allocation to any individual name, I think you really need to take a look at that. If it's a really high risk name, consider that a speculative investment. I don't want more than 10% of my portfolio in speculative stocks. And that's probably even a high number for me. I don't really want a lot of speculative plays. Sure, I have some. Sure, we've talked about them. Maybe a DraftKings. Maybe, pick a name from years past. I'm sure we have plenty of them out there. I'm looking and I'm not seeing anything that's jumping off the page at me, but I'm sure if I do a little bit of a dive here, there's a lot more speculative names then maybe we want to get into, especially when it comes to the investing challenge, because we're looking for those trends. We're looking for something that could be the next big play sometimes. But the majority of those stocks are in solid blue chip names. I'm not saying just Procter and Gamble or Walmart or Costco. Maybe not just those household names. Maybe it is something that's a little bit more chip related. I know we've talked about Adobe, which hasn't been too hot, although a lot of these types of stocks did start rolling back. We saw ServiceNow start coming back up. I will pull up some of these. I won't just bore you guys with my face this whole time. Let's take a look here at ServiceNow. I'm going to go ahead and get this pulled up. We're going to share just what's going on over here. And I didn't even really look at ServiceNow. I just know that it has been on a bit of a run. So yeah, we can take a look here. The low was at $81, and we're sitting at 124. So 40% up since April. So that's it's a pretty solid rally as far as I'm concerned. That starts to show that this is turning around a good bit. We were down here $90. It says on this page over here that April 10th we were at 81. So it probably did get down to a low on that day, maybe pre-market, and then maybe it opened a little bit higher. It looks like I see 83 over here. But nonetheless, right? But that PE is still stretched, right? And that is one of the concerns that we have when it comes to Palantir. That stock absolutely just blew the lights out on this earnings. They announced everything we wanted to hear. Everything possible went the right way when it came to Palantir, right? So PLTR, if we look at this 5-day, we're going to see that this stock just blew the lights out, right? We were down here. I think we were even cheaper than that. This might have been further back, right? So yeah, we were down 123, and this was July 28th, and now we're sitting at 172, right? So a lot of things went right. Let's dive into that, right? Let's pull up that one. Where do we want to see? What did we want to see from Palantir, and what did we get? We got 93% year-over-year revenue growth. Absolutely massive. They were already growing pretty solid. I don't think anyone was really accounting for 93% of revenue growth. U.S. commercial grew 149%. So that's a lot of government, big institutions, corporations. That is the driver there. Another major guidance increase. They said they're closing more deals. We got a strong pipeline. We're looking at still continuing this growth. We're not done at this point, right? Revenue guidance raised to approximately 8.15 billion. So we already grew 93%, and now we're going to raise again for fiscal year 26. Management produced its largest ever guidance raise. So the biggest raise that we've seen, plus we just had 93% of revenue growth, plus 149% of commercial U.S. growth. So we jumped 30% in 1 week, including a huge move immediately following earnings. Finished at about 172, up nearly 40% for the week. So that's massive, right? Enormous growth for the company of this size. Even if it's a smaller company, that is still a massive move. Maybe, penny stocks, you might see that on any kind of good news. We closed a deal. This patent, we got it for our medication. We got the banking charter, whatever that might be. We might see a 40% growth in some of those smaller names. But this is absolutely just massive for Palantir. But it is still a valuation problem. It is 100% a valuation concern. So yes, we're approaching a $500 billion market cap. Shares were roughly 55 cents of the level corresponding, within 55 cents of the level corresponding to a $500 billion valuation. So if we got up to like 172 and a half, right? The business is solid. The growth is solid. The AI opportunity, massive. The valuation, right? The valuation is the fear. This is an expensive stock. I'm not going to say that it's not. I don't know that I want you to go all in at this point. I wouldn't. I would not do that. I never tell you to do that. Now, is it okay to buy a little bit? Sure. How much do you want to buy at this point? I mean, obviously the time to buy would have been last week, but again, crystal ball problems. If it was in the shop or getting repaired and you didn't buy last week, what do you do now? Well, I think you maybe buy maybe 10% of what you want to do. Let this thing kind of come back down, maybe get a little bit of bad news in the cycle, buy 10, 15% more, and then just keep kind of adding until whatever that position size that you're looking for, right? So if you want $10,000 of Palantir stock, maybe you buy $1,000 this week. Then maybe, hey, we wait another couple weeks and we say, oh, it came down to 160. I like it at 160. I like it more than it was at 172, right? It's still a great company. It's still got good growth as long as that underlying, all these good things that they just set up here, as long as this doesn't change, we still have revenue growth. We still have guidance increases. If they came out and said, hey, we dropped the ball. Our guidance that we thought was going to be increased, 3 deals didn't come through and it's going to actually be lower. And then what happens? Well, this 40% gain could just disappear, right? We could see the stock go down 20% in a week. And at that point, do you really want to buy it? Well, that kind of causes a little bit more concern, right? We don't have this major, if this major guidance increase doesn't happen, that could be something that I say, hey, maybe pump the brakes for a second. Maybe you add a little bit on some of that weakness and hope that they get that business back. But that is a little bit more concerning, right? So I don't want you to go in all in on this good news and then wait for some kind of bad news to come out and then panic, right? I want that bad news to be a time where you can add a little bit more, maybe make some different calls. But if this underlying business stays strong, I think we have a winner here, but there is a valuation concern at this point in time, right? Conversely, right, I'm looking down here at Celsius, right? Now, ChatGPT says this is the one that actually has a problem. There's a couple different things here, right? Revenue up, right? Revenue was up 11%, 817.9 million. Gross margins were at 48.1 versus 51.5. I don't know if that's what was expected or if that's last quarter or year over year, but margins were down a little bit. Net income down 45%, 55.3 million. And that's a huge number, right? That is a big scare. Now, a lot of that income, when you actually break this down a little bit more, it was due to some declining sales of Celsius, but there was also a lot of investment into distribution and advertising and things like that did bring this number way down. So some of it is setting up for future gains, but at the same time, we also had the core Celsius brand sales were down 12%. That's not what you want to see, right? You thought you were buying Celsius for the fact that this brand was going to compete with Monster and Red Bull. And now, is it just the flavor of the week? Does Red Bull and Monster have more staying power? Are people going back to coffee more? That's a big concern, right? We don't want this core business to go down. Yeah, Alani Nu came in and they generated $364 million, up 21%. But is that the way that we want the business to grow? Do we want to have to keep making new brands and then kind of establishing them, building out that Alani Nu line? Do we want to have to continue to buy new brands rather than simply just have all of our, brand core awareness in Celsius, maybe have a couple offshoot companies, but do we really want that core business to decline? And the answer is no, we don't. And that is why it declined so hard. It did drop around 14% following earnings. It did get down into that 24 range. I did actually write a covered call, or not a covered call. I just bought 2 options on this. I thought it was a little bit overdone. That may or may not turn out to be true. As of right now, it looks like a decent play. Like I bought those for a dollar share, so $100, and I bought 2 options contracts. They expired beginning of September, and they're already up. Right, I bought them. They are $25 strike price, and the stock is at 27.7. I think at last check on Friday they were worth like 270 per contract, and I paid $1 for them or $100 for them. So they're up 2.7 times. I might trade. I might sell them. I might hold them. I'm not 100% certain at this point. If things keep going up, I might just end up buying the shares. I might buy, a couple hundred more shares at $25, especially if this thing goes to 28, 29. It feels like I'm getting a discount on the shares that I already wanted to build a position in. I know that advertising was a fear, but I also know that we are going to have these kind of ebb and flow as to what's hot this week, what's not. Are they going to build out in Europe? Is that whole distribution and advertising going the way that we want it? So there's a lot of different things you got to unpack with the fact of, yeah, this stock didn't have a great quarter. Yes, some things went well. Yes, Alani Nu is getting some more sales, up 21%. That's great. But that's not where I wanted to see the numbers come from. Then you also have the CEO of Rockstar, if you remember Rockstar Energy. He sold that business, I forget when it was, a couple of years back to Pepsi, I believe, for like $3 billion. And now he's trying to buy Celsius shares, right? So he essentially is saying that I want to take over Celsius. And I think that's a major concern also. So you've kind of got multiple problems. I don't know that the board would go for it because he already had the shot and didn't get there to beat Monster or Red Bull with Rockstar. And it was always kind of like, Red Bull Monsters, maybe 2 for $6 back in the day, a couple of years ago. And Rockstar was like 2 for $4 or 2 for $3.50 or whatever. It was always that cheaper product. I don't know that I really want to go down that path of trying to have the same guy that tried to beat Monster and Red Bull come in and now try to rebuild, rejuvenate, take Celsius to that next level. I don't see that would work. So for those reasons, I hope that he doesn't get in. I understand that he's buying shares. I think that's just something that I don't want to see is him get in and start purchasing more and trying to throw money around, throw weight around, and someone just say, all right, yeah, you got it. Let's see what you can do because of, the current CEO. Maybe we spent too much. Maybe the sales weren't great. I'd like to see where this thing can go without him that already had a swing at the plate. I won't say he struck out, but he wasn't the home run king that we were hoping for when we got into Celsius, right? So that is where I'm at there. Metastock. This is another one that, I told you guys under 600 I was buying. We had this good news come out a month ago, got up to 681, and then some earnings and spending came out, and we got down here to 539. Well, I was buying around 550-ish. Kind of buying up here. Like I said, under 600, I still really like this stock. What does ChatGPT tell us? And so Meta, right? We were talking about the fact that Meta has a CapEx problem. We've talked about this kind of ad nauseum at this point, and we've talked about it with other massive names. So this probably doesn't come as much of a surprise. Revenue up 28% year over year. EPS 618 versus 714 a year ago. That's not going the right way, but we know why, right? Net income 15.85 billion, down 14%. Not what we want to see. Ad revenue up massively, 27%. That is their main business, is ad revenue. And they just increased it 27% on what was already a massive number. The core of their business up 27%. Margins came down, right? Massive AI infrastructure remains the issue. We've talked about this, and we're probably going to say it again, but every time this thing goes on sale with a CapEx concern, I want to be buying it because it just keeps rebounding to new highs, right? I think that the management is making good decisions, but it feels painful when you see these massive billions of dollars getting spent on AI, when they said that it was going to be the metaverse company, when they changed the name to Meta. All these things are scary, right? We're seeing it time and time again. So the distinction here, the advertising business is extremely strong. It is growing. Ad impressions increased and pricing remained strong. Earnings decline was largely about the enormous increase in expenses, AI investment, legal, and restructuring costs. So we know why these numbers are down. It's not simply like a lack of business. They got the business. The business is there, but the spending is the problem, right? So again, I mean, they're saying basically the same thing. Market isn't questioning whether Meta has a great advertising business. It's questioning how much AI spending can rise before the incremental return becomes questionable. And if we're only getting a 3% return and we're spending, just exponentially, why? Why are we doing that when we could just focus on what we have? But if they get it right and they get AI right, they get the next wheel of cycle of advertising, of AI, of Meta, of all of that. If they get any of that right, it's going to lead to huge, just enormous future gains. So I don't want to bet against them. I think they've proved before that buying Instagram worked. They haven't really monetized WhatsApp yet. There's still other ways for them to grow, and them spending. It is scary. I mean, the fact that they're building out more and more data centers and everything that they're building is very, very expensive. So for me, I still believe that it's a buy under 600. And again, like for me, this is more of a core holding. It's not the smaller portion of my portfolio. These are the names that I want to have a bigger piece in. So I am not concerned with buying more on these dips, right? More favorably than others. Core business is accelerating. Margins are what we're fighting about. And I mean, it's telling me to say that Meta didn't have an advertising problem. Meta has a spending problem, but I've already been saying that for months, years, whatever. So nothing has really changed there. Um, Amazon AWS was a standout number, and Amazon Q2 earnings materially changed the AI cloud narrative around Amazon. Year over year growth was 37%. That is insane. Revenue from AWS is 42.2 billion, margins of around 40%. Growth acceleration was the fastest in 18 quarters. Got a backlog of 469 billion. Amazon AWS revenue growth accelerated sharply, 37%. Fastest growth, yeah, it's the same thing, just recap. Particularly impressive because AWS is already a $40 billion plus quarterly business. That's insane. So it's still growing. This hasn't stopped. The spend that they are doing is proving that it's working well. And that's why these numbers and these companies are continuing to grow after this earnings report. I mean, we're just seeing, I don't even want to say the tip of the iceberg, but we're in the beginning innings of what we can do and how long this growth cycle is going to last for a lot of these companies. But I don't want to get over our skis on any of them. And I really have a problem with that. Even in my position in Micron, it's probably a 10% position. And I've been on here saying for years, like 5 to 7, maybe 8% is kind of where I want to be, but I also don't want to just get smacked with this tax bill, right? I really don't. So that is a really tough position to have. And like, where do you want to go? Do you want to face the tax man, or do you want to run the risk of not losing it all? It isn't going to go to zero. I mean, for Micron, I don't see it going to zero, but I also don't want to have it go cut it in half and then, oh yeah, I'm at 5%. That's where I wanted to be, but I did it the hard way, right? I don't want to see that either. So you're kind of caught in this pickle of, do you want to face the tax man or the IRS, or do you want to sell off some and, kind of lock in those gains? And I've told you guys, I'm writing the covered calls. I'm doing some options. I'm doing some different things with it. but I probably need to trim. And I've told you it's probably about an 18 to 24 month prior to peak. I still think that we have growth probably into mid to late 28. I don't see growth stopping. All these companies that we just saw report, Meta included, saying, "Hey, we're spending like crazy. They're spending on AI. They're spending on these chips." So I think that there is that growth there, but we do want to be mindful of what's going on. So again, I told you guys a stock at the end of the World Cup that I wanted to hold for 4 years would be Amazon. It's not so cyclical, right? We don't have this boom and bust of like what we're going to have with semiconductors, like we're going to have with Micron. That's going to happen. Amazon can just find another lever to pull. And oh yeah, AWS is up. Oh yeah, retail's up. Oh yeah, we bought this new business. We're advertising more. It is becoming an advertising engine. There's a lot of different things that Amazon does that they do really, really well. And it's not simply just one thing, right? You got a trailing 12-month PE of a 21. I mean, that's pretty awesome. If you're looking at, let's pull up Refinitiv real quick. We're going to share this one. Still a buy, right? We've got annual revenue of just $775 billion with the B. We're closing closer and closer to that $1 trillion of revenue per year, right? So, and it's only up. I mean, I'm gonna say only up 62% over 5 years, 22% over this year, and if you take out the gains over the last week, it's probably in the mid-teens. So, I still think it's got a lot of room to run. There's a lot of things going really, really well for them. If we're looking at forward PE, yeah, it's a 29. It's probably in line with their 5-year average. We still have around 17% of upside. I feel like that's comfortable, right? I don't think that that's a pie in the sky type number. I think that's highly obtainable for them. Yeah, it looks like some of these revenues or earnings are gonna come down for the September quarter and the December quarter. I'm not too sure why that is, if that's normal for them or not. Looks like some of these numbers could potentially drop for 2027 based on earnings per share, possibly on expenditures, possibly on that CapEx. We could dive into that a little bit more. But annual revenue still, staircase, just 15% and then 32%, probably 15 to 16% per year for the next this is 26 included, but yeah, I mean, we're looking at numbers that are pretty much the same across the board there. So we've got that. We've got, let's take a look here at just what we're seeing on some of these numbers. Actually, forward is actually a huge discount, 41% discount. I didn't realize their 5-year average was that high at a 50 times forward. Price to sales of 3.8. It's a little steep. I would like it to be much cheaper on a lot of different companies, but Amazon and the growth that they have feels reasonable, right? It's higher than their average, but it's reasonable. So their forward peg ratio is a 1.5, and their 5-year average is a 1.8. So it's not super cheap, but it feels like a safe buy. It feels like a safe buy. So if you are looking to build a position, I could certainly say, hey, 25% right now, and then buy it every 3 months until you build out that position is probably an okay number. I feel comfortable buying here. I don't know that there's ever really been a awful time to buy Amazon stock. And I mean, that's kind of one of the ones that I would just continue to buy here. And as I say this, I am getting caught up with you guys kind of in real time. So there are different things that are on the list that I haven't really paid attention to. I've been, like I said, out of the country. I've been traveling. When I got back into the country, these numbers, business was busy. I had to get caught up. So now I'm looking at all these stocks. I still really like a lot of the same names. I'm a little bit more neutral, I'll say, on Nike. I'm not sure where these numbers go. And I've told you for a long time that Nike is going to be a stock that is going to take a while. And it's kind of a speculative, I kind of feel weird saying that Nike's speculative. It's really not, but I feel like it can rebound. But I definitely know that the it's saying that it dropped. Hopefully, you guys can still hear me. It's saying that well, the platform dropped, and hopefully, it's connecting. But anyhow, it says we're live and I'm recording, so I'm going to keep going. And yeah, so we're going to share this again. We're going to share the screen of Nike. Sorry about that. We're technical difficulties. Hopefully, this edits it out automatically. But yeah, Nike, 20 times earnings, 3.9% dividend yield. That feels right. It feels where it should be. At 20 times earnings on a Nike, almost 4%. Like that feels like a buy. But then you realize that Nike's got all these problems. We're not really growing. We're not really getting the traction that we want in this market. We're really not seeing where we want to be. Some of these price targets have been cut. We're only down to around $50, which is 20% of upside. But a lot of people, if you looked, 6 months ago or a year ago, a lot of people thought this was going to be an $80 stock, right? And it just kind of keeps teetering in this trajectory of like it doesn't want to get above. It kind of keeps setting lower highs and lower lows at the same time. It does feel like we've kind of consolidated in this low 40 range. I'm hoping that we can kind of start to break out. I'm hoping a little bit of good news takes this thing way up, kind of like what Palantir saw. I just don't know that there's that much good news on the horizon for Nike. So it does get really painful to know if this is a good call or if I should cut my losses and maybe sell my shares and put that money somewhere else that I feel like a higher conviction in right now. And then part of me says, I don't know that I want to get into more tech stocks. So like, where do you put this money to play? Is it in healthcare? Do we start buying some United Health? Is this thing getting out of its own way finally? You see a little bit more upside there. That could maybe be sooner. CrowdStrike. I mean, we haven't talked about that one in a while. I still think that cybersecurity is massive, but it's been on a run. So do you want to buy it when you're staring at 11% of downside? And granted, that's only analyst price targets. I'd have to dive in a lot more. Do you look at something like Becton Dickinson, BDX? That is a lot of healthcare stocks and technology, but you're looking at AI, but you're also having it face healthcare. So that's maybe, maybe not the best one, but, something like an Eli Lilly that, I like, but it feels like it's very expensive. It's $11.85 a share. And now, yeah, it could go to $13.75 and that'd be great. But is that where you want to go? I'm not too sure. I like both names. I like United Health. I got out of it after all the CEO assassination or whatever you want to call it. And it felt like they just couldn't kind of get their footing. We didn't really know where it was going to go. And maybe similar with CrowdStrike. I got out of that after some, serious outages, and it was caused, across the country for like 2 days, and we couldn't get on the internet and things like that because of CrowdStrike. We kind of got out of that. That was to do with a lot of the airline stocks. People couldn't route their passengers correctly. So that was a lot of CrowdStrike outages. And then they kind of pointed the finger and said, oh, that was whatever airline. I don't want to quote because I forget exactly which one it was. But I know that Delta did just have another plane make an emergency landing in Atlanta. And you guys already know my problems with Delta and Atlanta. So we're there. I'm still not buying either of these. I will say that JetBlue to Costa Rica and Southwest both did a heck of a better job than what Delta did. JetBlue is, nothing that I'm investing in. I'm not investing in any of the airlines. We've talked about that. I don't really like investing into a lot of food stocks either. Elf Beauty, we did talk about this one. This thing's closing in on $100. This thing was $40 like 3 months ago. I mean, just astronomical moves here. I was very happy to see the gains here that we had with Elf. That is massive, right? We were down here. This was $49. This is on the 3 months. So that was only not long ago. Where's the date? June 5th. June 5th, we were sub 50, and now we're almost at $100 on Elf. Man, that's a crazy run that we had there. So that one's done really well for us. SpaceX, we're kind of doing just the tour of the market right now, I guess we'll say. SpaceX, man, this thing got down to like 110, maybe 107, something like that. And then we started seeing this thing turn around. So yeah, we were down to 108, and now we're at 133. I told you guys in that one teens range I was buying. I know there's some big YouTubers saying that, hey, $80 is my price point on SpaceX. That's great if it gets there. I would be buying at $80 also. But I wanted to start tiptoeing in the one teens, and I'm okay with that. If it gets to 80, I'll be okay with that too. I'm going to continue buying, and this isn't just going to be an overnight story. This is going to be a 10 or 20-year story as far as I'm concerned. So the fact that they are there, if we can get it at 110, I'll be nibbling. If we get down to 80, I'll be buying heavy. That's kind of where I'm at with this one. So for me, the fact that it's up 15% on Friday was great. But we'll see where this thing goes. I don't have a full position yet, so I might buy a share a week or whatever I do to kind of slowly build this thing out. I don't want to just rush in because if you bought a month and a half ago or whenever this thing opened and it was over 200, yeah, I mean, you got burned, right? You've got a different feeling and taste in your mouth if you bought this thing at 210 and then it goes to 108 versus me buying at 110 and it goes back up to 133. I feel okay, but if I bought at 210, I'd be, oh man, what did I do? Why did I rush into this thing? So patience is a virtue, and you need to practice that in the market for sure. So that's a lot of stocks in a nutshell, real quick, real fast. What are we buying this week? Nike, no. SoFi, I want to see this thing win. I really do. Salesforce, I think they had a decent turnaround here, probably in similar path of not Adobe. What were we just talking about? ServiceNow, that was the one. So Salesforce sitting at 192, right? That's where we were, 192. We got down to 146 on June 22nd, and at the beginning of the year it was at 252. So we're kind of middle of the range. I like the turnaround. The software as a service and AI enabled tech stocks, I do like them. It's just hard to know if this is going to be if we're done, if this is going back up. We're seeing. So what does the market see? Refinitiv says buy, positive. Smart Consensus says buy. Trefis down here says we're got about 41% of upside. Price estimates 263. Maybe this is still on sale. Maybe it is. I'd like to think that it is, right? It feels like it should have been higher. Adobe, let's just check back in. This was 329 January 2nd. We're at 264, so still down significantly, but well off the lows of 190 back on June 18th, right? So this is turned around. The PE is cheap. Is this a buy? Morgan Stanley is underweight. Refinitiv says positive. Smart Consensus says buy. They probably changed that. Oh no, that was last reported today. So that might have been kind of fresh. Trefis says around 27% of upside. AMD, this thing did come down 483. Remember those covered calls I had were at 450 and I sold two covered calls, which I didn't want to do, but I entered the trade incorrectly because I was not focused. It wasn't a lack of patience. It was a complete lack of paying attention to what I should have been doing. And that's okay. I mean, it's not ideal, but crap happens. We'll say that. I still really like this stock. This is really pricey on that trailing 12-month PE. We've got Refinitiv at a neutral. We got Trefis at a minus 47%, which I think is completely bogus. That is not a good number. We have a lot of good news coming on here. We've got, let's share this one, publicly traded also, but that doesn't get out of its own way. It's always cheap. So that's not something that I would want to buy either. But AMD, sidebar. Refinitiv has it as a buy. 5-year return of 344%. So pretty solid there, right? We'll take a 200% gain in a year. Hopefully you guys got in on this one when we were basically slamming the table saying, hey, I'm buying this. You do what you want. I can't tell you what to do, but I'm doing it. 21% of upside. MI 450 chips are coming out. Let's get down to the numbers that really count. All of them count to some extent, but I just want to know if we're at a good price entry. Price to sales is at a 21. Trailing PEs at a 160. Forward PEs at a 54. I don't like any of that. So the growth has got to be through the roof. And that's the thing, is it is, right? We got a forward peg ratio of a 0.9. But you have to also couple that with the fact that you're paying through the roof on these numbers. So if the growth doesn't come in how they anticipate, you're going to be punished, right? And this thing could sell off massively. So we're looking at a company that is forecasted to just continue winning, but currently it is trading at a super high valuation. And that is the scary part, right? So if we don't hit this 46% of revenue growth in 26, or this 148% revenue growth for 2027, meaning from the end of this year to the end of 27, it still has 100% of revenue growth. I mean, this is not a small company anymore for 100% gain in a year on revenue. Can they do it? They think so. The market seems to think so, but it is very expensive. So tiptoe, right? And I think I've told you guys before that the time to buy it was 18 months ago. Is it too late? I don't know. I personally feel like this stock can go much higher. I feel like we could see these numbers come in, and then all these other PEs forward, trailing 12 months, price to sales, it all is justified by that point because they hit the targets. But if they miss the targets, well, then, it's going to be, the stock price is not going to be reflected as to how I think it could go. It's going to be traded much, much lower. So that's what I got there. I don't know that I want to buy that. Nvidia already rolled up. Microsoft is already rolling up. Amazon's already rolling up. If I'm looking at stocks that are on sale on our list, we're looking at CRM, Salesforce, Adobe, Celsius, maybe some SoFi. I don't know. I think we maybe go with something that we haven't looked at in a while. Maybe that's going to be Salesforce. I think we're going to buy Salesforce for the upside, for the fact that some of the software as a service or SaaS companies are kind of coming back into flavor. It seems like that could be a good way to go. And hopefully some of these models and these growth numbers are correct. So that's what I'm going to be buying this week for the investing challenge is going to be Salesforce. The ticker is CRM, Customer Relations Management, and Salesforce is one of the best ones to do it. So yeah, that's what I'm looking at. That's where we're going to be buying. The earnings is solid. The PE is fair. We've got some upside. Yes, I'm down on this. Yes, I have a covered call out on this. And I'm hoping that it stays under this $200 covered call. I could sell it. It's not the worst case scenario to sell it. And this is going to be expiring on the 21st. So I've got 12 days to go on this covered call. If it stays under 200, great. I might close this. It might be getting too close. And I think that the market could shift. And maybe we start to see Salesforce run back over 200. So this has kind of been there for a while and kind of is what it is. So I'm going to be buying some more. Hopefully that's a good answer. Hopefully that's something that we like. If you guys got any questions, feel free to comment or, write me on any of that YouTube or on Spotify or wherever else you're listening. And please make sure you like, subscribe, and share. That's all the time that I got for you tonight. Thank you very much for stopping by. I'll catch you guys in the next one. Take care.